them. Vinit Sambre is with us, Head of Equities at DSP Mutual Fund. Vinit, good morning. Great to have you with us here. Prashant, this side. Now, let's just actually, why don't we, we'll get to the markets in just a bit, but this, once again, effective competition. I mean, actually, more sectors, right? Competitive intensity is super high, actually increasing. Wherever there are lucrative margins, decent profit pools, there are entries, newer players coming in. I mean, we were talking to in the AC space. We had Blue Star yesterday, and we were asking them 65 companies in that space. But just your thoughts on this wires and cable segment, and I'm sure you have exposure.
Yeah.
Broadly, what do you make of it as an investor?
So, Prashant, first of all, let me agree that incrementally, most sectors, we are seeing a lot of disruptions, just not the competition, but also technology disruption, which is taking place. And, a lot of it is actually leading us to sort of go back to, our financial modeling and just see whether, some of this is still making a case. Are the companies losing their core moats? So I think the investment climate overall is becoming very, very challenging, and we have to be sort of very alert in terms of how the companies are keeping up with their competitive modes actually. So that is one very important aspect, especially on the wires and cables. Let me say that I was trying to look for the history when a similar thing happened in case of paints business as such. And when we go back in 2022, when Grasim made that announcement to get into the paints segment, actually we had seen the paints company for 6 months still doing well. Maybe it was because of the demand environment, and only after 1 or 2 years it really struck that it's hitting up and it's going to be impacting their profitability. So we saw the reaction in the stock price maybe 2 or 3 years down the line, and the stocks I think corrected by 30-40%. And this playbook was available as the announcement happened in case of wires and cables. We saw that immediately the stock price actually reacted. So, I would imagine that the business opportunity is going to be large. Today also, when we think about the power sector investment requirement, not only in India, but globally, I think it's going to be huge. And from that perspective, some of these companies would still continue to see maybe decent growth. And the new entrants will also have maybe 4, 5, 7% of the overall market by FY30. But important point is that the stock reaction has already happened this time because the playbook was available. Investors got worried very soon, and 20, 25, 30% reaction has happened. Maybe some more reaction and the stock starts looking attractive from valuation perspective. I would believe that the growth challenge is not going to be there for these companies, and hence at some valuation, it would make sense to sort of look at some of these companies as such.
That's an interesting one. So some correction has already happened, a little more, and then it becomes attractive. Vinit, always good to speak to you. There was an interesting analysis that came from your house, which was when the mid-cap index was down almost 23-24% from the highs. The analysis was that about 8% decline was due to earnings degrowth and 15 to 17% was due to derating. Now that we've seen a recovery from the lows of almost 5 to 6%, how much do you attribute to improving earnings prospects, and how much do you attribute to, valuations resetting?
So, Mangalam, this is all very short term and driven by sentiments rather than any big earning change. I think for me, if you ask me, I still consider that March quarter will be, again, looking like downgrades of earnings from where we were. And this is coming from, the commentaries we are listening from the management. It's a bit cautious, and I think you guys are also talking to the management. There's no real, recovery which is broadly seen across different segments, and hence I would imagine that we are still under some risk of earnings downgrades, maybe 1 or 2 quarters more. But good part here, Mangalam, is that we have seen 4 or 5 quarters of sequential earnings decline. We already have seen a low base creation, and in some form or fashion, the macros eventually should sort of turn as we see that monetary fiscal, some bit of that space is easing out with the stance taken by RBI. So and the hope is that consumption should start seeing revival maybe towards the end of this year. So I would say that things can turn around from here. Maybe 1 or 2 quarters of pain, markets will slightly be ahead of that, and hence today we are seeing these corrections and then bounce backs. But I think there are from the corporate side, some more pressure points still may be there in the quarters to come, 1 or 2 quarters.
Vinit, hi. Good morning. Good to be speaking with you on the show today. So since you're saying that consumption is likely to bounce back, let's talk about how you'd play it. And there's been enough debate around it, right? The top-end premium-level consumption, but then we got into the narrative of the urban consumption slowdown. After the budget, the narrative changed to that now that there is, people have 1 lakh rupees extra to spend, they'll go to QSRs, etc. So you tell us, what are you convinced about in consumption?
So I think, Surabhi, you're right. It is very unclear, and the wallet shares are changing. People are also now traveling a lot. They're spending a lot on hotels. We don't know where exactly the spends are going to take place. But the way to think is that we go back in history and see that. So first of all, we have benefits of taxation. The welfare, schemes are maybe giving some more benefits to the people. Inflation coming down is good for the rural folks because they were affected post-COVID. And I think towards the end of this year, we'll start talking of the 8th pay commission benefit, which last time around, it did help auto sector in a big way. So, instead of really focusing on where exactly we'll see the benefits, I would say that we'll have to create basket of consumer discretionary stocks as such, because we believe that these are durable. The tax benefit is a durable benefit, and people may want to build these kind of assets where on the discretionary side it can be auto. People may like to spend on hotels, QSRs, and all of those. So we have exposures out there, and we are actually incrementally looking at this space. Maybe retail at certain valuations could become attractive. Right now they are all going through a bit of a slowdown. And what Prashant mentioned, I think one thing which we'll have to keep worrying about is the competitive dynamics across the space, which has become a very important factor to think before we buy with a long-term view.
Sure. So you mentioned that in this basket of discretionary consumption, you'll probably put autos, maybe hotels, maybe retail at some point. Where does that leave quick commerce and the platform companies? Because the problem is their sales numbers were fine, even the profitability looked okay, but now they're reinvesting in the business, they're opening all these new dark stores, and the market got a little worried. Where are you on that space?
So there, actually, we are still seeing their competition is heating up, and that may not still mean that these companies will see light at the end of tunnel soon in terms of the profitability, and which is where we have taken a sort of a pause out there in terms of going aggressively on those names. But we are watching that space. We know that, as I spoke about the wallet share, I think they are catering to a big need which is there. Just that need needs to get converted into pricing power, and that should eventually deliver profitability. If that path becomes clearer, I think it would make a good case for investment out there.
It's interesting, some of the names that you hold in some of your funds, you do have small ticket discretionary items from the consumption space like Safari, you have Thangamile, LT Foods. Interesting, updates coming in from the retail and textile world as well. Vinit, the question I'm curious to know the answer for is, in this decline that happened, did you top up on already existing names, or did you buy something else as well, which was always on your wish list, but because it had run ahead, you couldn't buy it, and now the valuations seemed attractive? If you could give us a sense of what you did.
So a large part actually went into our own existing stocks, because there we already have our own understanding of businesses, and we slightly increased the exposure. And we also took this opportunity to maybe cut exposures in names where we felt that the overall outlook for them would be slightly more elongated in terms of recovery. And new names we keep watching. So as a proportion, I can say that maybe higher allocation to the existing names versus the new names. And new names also are finding their way into the portfolios as well.
What would the nature of those companies look like, the new names?
Yeah, so I think it is to do with where the businesses have seen low cycles. So specialty chemical as a pack is one area. Auto ancillary, I spoke about the auto, but auto ancillary seems to be a better way to play all of these. Some consumer names we are watching. So I think in and around these segments, the names would sort of lie.
All right, Vinit, thank you so much for joining in and giving us your views on the market and talking us through the sectors and stocks that are not specifically stocks, but ideas that you like after this correction itself. But